Hello everyone, I'm Rakshith Pai and in our today's social media question series, I'll answer the following question. I want to invest in Indian stock market, but all the good stock are expensive, ranging from 1000 to 3000 per share. What are some of the stocks which are less expensive that I can buy for the long term? This is a good question and I'm pretty sure some of you guys might have the same question in mind. When I started investing in the stock market, I too had the same perception that a stock worth 100 rupees was cheaper than a stock worth rupees 1000. And in one aspect it is true, but if stock worth rupees 100 has a market cap of 100 crore and stock worth 1000 crore has a market cap of 10 crore, then what company would you consider as cheap? The answer is neither. You can't define a company's worth by its per share price. Neither can you define the worthiness of a company by the price as quoted in the stock market. Meaning a stock is a share in the business and the lower digit per share, say rupees 10 per share, means either the company itself is small cap company with a market cap of 100 crore, or now this is very important, the company has diluted its equity so much that they have millions of shares listed, each worth few hundred rupees. For example, ITC Limited has over 1230 crore equity shares, each worth rupees 235 per share as per today's listing price, making the entire company worth 2.9 lakh crore. What do you think? Is ITC Limited a cheap stock at rupees 235 per share when compared to its market cap of 2.9 lakh crore? Check the link in the description. I have written an article about ITC valuation, and I hope this concept is understood. Right now the market has rallied very well in the past 12 months, so compared to the past prices all the companies look overvalued, but you are just looking at the price that was quoted then towards now. What you are missing out is on the growth in earnings. With an economy opening up and going to normalcy, you can expect the companies to come up with higher revenue figures. At least I'm optimistic about that one aspect. When a company posts better earnings, the high PE figures will drop down because the denominator earnings are coming up. Whenever we try to evaluate a company, we tend to look at its past figures to try to come up with the current value of the company, right? Doing so is fine, but if you don't consider what growth in earnings or cash flow the company could be able to come up with in near future, then you will be looking back and judging while the stock market in itself runs on a future note. And since you have asked for some of the best companies to invest in, I'll prepare a list and either upload it in my website or shoot a video over it. So I hope that answers your question. Thank you for watching.